In theory, global finance operates like water. A few taps on a screen and capital flows instantly across borders, seeking the best returns without friction. But that theory completely falls apart when you look at the experience of Mark Mobius. Mobius is a legendary Wall Street investor who spent more than 30 years aggressively putting money into emerging markets, specifically China. In early 2023, he attempted what should have been a routine transaction, moving roughly 3 million renminbi from his personal HSBC account in Shanghai to his own account in Hong Kong. The bank stopped the transfer. They didn't cite a specific law. Instead, they demanded that Mobius provide 20 years of continuous printed transaction records to prove the origin of the funds. For an investor who has spent decades navigating the regulations of developing nations, this was a level of administrative resistance he had never encountered. The requirement was, in his view, completely irrational. This impossible demand for paperwork suggests that Mobius wasn't facing a simple clerical error. The friction he experienced is the first visible layer of a strategy to ensure that once capital enters the country, it never leaves. These same barriers are now appearing at the retail level for everyday citizens. In Tianjin, a local resident recently attempted to move a modest amount of savings abroad for personal travel. When they approached the bank teller to process the wire, they were refused service at the counter. The staff instructed them to use the bank's mobile app instead, claiming the digital route was more efficient. The app, however, functioned as a digital maze. It forced the user through constant security verifications and repeatedly blocked the transfer with automated messages stating that the transaction limits had been exceeded. After the user followed every instruction and lowered the transfer amount, the app delivered a final paradox, a message stating that for their own safety, they had to return to a physical bank branch to complete the process. Back at the counter, the requirements were even more extreme. The bank demanded physical flight and hotel receipts for travel funds or official school acceptance letters for education transfers, treating personal savings like state-controlled assets. This micro-friction is driven by an August joint mandate from China's central bank and financial regulators. It enforces strict due diligence for any outbound transfer over $1,000. Local banks have been transformed into active gatekeepers. Their goal is no longer efficiency, but bureaucratic exhaustion, ensuring that retail wealth remains trapped behind a wall of paperwork. Beijing is now applying this same logic of containment to physical corporate assets and global production lines. Apple has been at the center of this shift. After years of relying on China for over 90% of its iPhone assembly, the company is now aggressively pushing to reduce that share to below 75%. To compensate for the reduction in China, Apple is rapidly scaling its manufacturing in India, aiming to reach 25% of its total global output there in the near future. In response to this industrial exodus, China drafted a geopolitical countermeasure, sweeping new supply chain security regulations. These rules grant the state authority to intervene and legally block foreign companies from moving their production out of the country if officials decide the move threatens national supply chain security. Global megacorporations are now facing the same lock-in strategy used on private bank accounts. The state has decided that if the market won't keep capital in China, the bureaucracy will. Beijing's strategy is rooted in a deep-seated fear. The leadership is terrified of systemic financial risk and massive, unbridled capital flight. Under the current administration, the ideological focus has shifted. Absolute regime security and internal control are now prioritized over further integration with the global economy. This posture is the opposite of the previous era, which was defined by sweeping market reforms and a commitment to economic opening. The government now operates under the philosophy of guojin min tui, meaning the state advances while the private sector retreats. This tightening grip is meant to ensure that no major asset can escape state oversight. However, these extreme measures created a paradox. By making it nearly impossible to move money out, the state makes investors more desperate to leave. This chart shows the hard data of that loss of confidence. Foreign direct investment in China plummeted to a historic low in 2024 as the realization set in that capital entering the country is no longer liquid. Both the US and EU chambers of commerce have issued warnings about this trend, noting that the loss of investor confidence is fueling a broader corporate exodus. China has transitioned from the world's greatest growth frontier into a geopolitical trap. It remains an easy place to deposit capital, but it has become a nearly impossible place to withdraw it.